Hi everyone, it's Dan here. In this video, I'm going to analyze Intel stock and try and decide whether it's a good time to buy or not. If you're new to the channel, my name is Dan. I'm a business school professor focused on accounting and finance, and the purpose of this channel is to help you build your wealth through saving and investing. So in case you don't know, Intel's core business is making computer chips, and they're a very dominant player in this industry. Now, Intel usually has a pretty stable stock price, as you can see looking at the past 5 years. But if we look at the performance over the past year, we see obviously the COVID drop, but we also see, look at this over here, incredible drop in price in one day. The reason for the tremendous drop in price is that on that day, Intel announced the delay of their 7nm chips. Ever since the announcement, Intel stock has traded around $48 to $50 a share with not much movement. There seems to be a very split opinion on how much this delay is going to impact their future earnings. This is something we're going to have to keep in mind as we do our analysis when we make assumptions about future growth. So the first thing I want to do is just look at some basic valuation ratios for Intel and see how they look and also see how they stack up against Intel's competitors. So I'm here on seekingalpha.com where I can look at all these metrics at once. And if you look over here, you have the price earnings ratio for trailing 12 months. For Intel is about 9.17. The sector median is about 34, so that's quite a deal. Also, if you look at Intel's 5-year average, it's 14.89. Let's look at forward earnings. Let's look at the forward PE ratio here. 10.93, just about 11. So you're paying about 11 times next period's earnings if you buy at this price. The average for the sector is about 30. And Intel's 5-year average of forward PE ratio is close to 14. So by these measures, it looks like a great deal. You can also see the PEG ratio here coming in at 0.35 compared to a sector median of 1.2. Also a great deal by that metric. And if we scroll down, we can find the price to book ratio of 2.59 compared to a sector median of 3.6. So comparatively, buying Intel seems to be a good deal. You are paying less for a given level of earnings or a given level of book value. Now, I like to look at PE ratios and price to book ratios and compare them to the industry as a quick check, but they should not be the final word. If you pick companies solely on the basis of their relative valuation to their peers in the industry, you're running a big risk. You're making the big assumption that the industry as a whole is not overvalued. In other words, you're assuming for some reason that all these other companies are fairly valued and the company you're interested in as a value, like Intel here, is undervalued. So a more thorough way to do it, and one of the most popular ways to value companies, is the use of a dividend discount model. The basis of the model is very simple. The only actual money you get from owning stocks is the dividends you receive. So in an efficient market, if investors fully knew what the dividends would be, the value of any company is simply the sum of all those dividends that you're going to receive over the company's lifetime. Now, because of the time value of money, we can't just say that $1 received next year is the same thing as $1 received 20 years from now. That's why it's called the dividend discount model. We're going to have to discount those dividends back to the present value. So here's the basic equation. The value or price at time 0 should be equal to the sum of all those dividends. You notice each one of them is divided by 1 plus R. R is what we call the discount rate. The discount rate has to be at least equal to the risk-free rate, the rate received on treasury bills. But it's often much more than that. The riskier the company, the higher the discount rate we should use in our model. So you take each dividend of year 1, dividend of year 2, all the way up to dividend of year N, which would be theoretically the final year of the company's life, and you divide them by 1 plus the discount rate to the power of whatever year it is. So dividing by 1 plus R to the power of whatever year it is takes those dividends and puts them into present value. The model is often written like this to make it easier on the eyes. Now, when we actually put the model into practice, it usually looks something like this. When analysts actually apply this model in practice, The most common thing to do is to simply forecast dividends out for the next 5 years. Most analysts agree that going beyond 5 years results in some pretty imprecise estimates. Now, because we figure the company will still be around after that 5th year, it still has more value than just those 5 dividends. So what's typically done is that we take the dividend we predict will happen in the 6th year and divide it by the discount rate minus the expected growth rate at that point in time. That's what that little g stands for. That's the long-term growth rate. So this last term in the model is usually called the terminal value of the company. Now, does this model actually work? Yes and no. It works better for stable, mature companies, which is what I would call Intel right now. It's not so great for young, growing companies or companies undergoing restructuring or significant changes. One nice thing about the dividend discount model is that whatever value you get from it is typically considered a floor, meaning the company is worth at least this much. So to make the model work, I need to know what their next period's dividend is going to be. I then need a growth rate for that dividend to figure out what the dividend will be for the next 5 years. So just from going to seekingalpha.com, I can find Intel's next period's dividend is going to be $1.32 per share. So to figure out how much Intel's dividends are going to grow over the next 5 years, we're going to look at their return on invested capital and their reinvestment ratio, and we're going to put them together. So Intel earns a return on invested capital of about 13.8%. Now 13.8% growth is tremendous. Will dividends grow by that much? Well, the answer is no, because they're going to take a lot of that money they earn and they're just going to pay it out to you as a shareholder, meaning they don't get to reinvest it. So we're going to look at the reinvestment ratio. You can think of the reinvestment ratio as the inverse of the payout ratio. So if you've ever seen a dividend payout ratio, you're just looking at the dividend per share divided by the earnings per share. So out of all those earnings, how much do we pay as dividends? For Intel, that number is about 27.2%, meaning their reinvestment ratio is 1 minus that number, which is 72.8%. So for every dollar they earn, they don't put that dollar back into their operations. They just put 72.8 cents of it back in. So we're going to take their return on invested capital and multiply it by this reinvestment rate, and we're going to get an expected growth rate of about 10%. Okay, so we're almost ready to use our model. We just need to figure out R and G. R is the discount rate. Now, because the Federal Reserve has slashed interest rates to nearly zero, we have a very low R. We're going to have a risk-free rate of less than 1%. I saw AAA corporate bonds are being issued at close to 2%. So I'm going to go ahead and use about 7.5% for my R. Now, as for G, G is the long-term stable growth rate. It can't be more than the growth rate of the economy in general. So I'm just going to pick 2.5%, roughly the level of inflation I expect. So if I take all these inputs and plug them into the model, this is what it looks like. So the model gives us an estimated value of Intel of $53.71 per share. This is a great result when you look at the share price, which is a little bit less than $50 a share. Considering the dividend discount model is usually a floor for the fair price of a stock, this is a screaming buy. The dividend discount model doesn't even account for the possibility that Intel is going to buy some of its own shares back over the coming years. Based on past history, they're going to buy back quite a lot. All of these numbers are in millions of dollars. So consider that. For a company whose current market capitalization is about $212 billion, they bought back over $12 billion worth of their own stock in 2019. And as you can see from this news release in mid-August, Intel is continuing their buybacks, buying $10 billion of their own stock back this year. Okay, everyone, so here are my final thoughts. Intel does face some serious risks. They have delayed the launch of their 7-nanometer chips. This could cut into their profit margins next year, as they may be forced to offer their chips at lower prices. You've also got Apple, who's developing their own computer chips, and they won't be relying on Intel in the future. This is going to hurt Intel's revenue long term. But I think it's important to note that neither of these risks is going to put Intel out of business. So, in other words, I don't expect Intel to go anywhere that fast. This is a pure value investment. Intel is no longer a huge growth company, but they're a very good value right now. You are paying between 9 and 11 times their earnings, whether you're looking at a traditional PE ratio or a forward PE ratio. That's an incredible deal. Between the growing stream of dividends you're going to be receiving and the share buybacks Intel does every year, they are an incredible value, and my recommendation is a buy at these price levels. Hope you guys liked the video. Let me know in the comments.